Have you ever thought that even when your investments are performing well, you might still be losing purchasing power because of inflation? Inflation is the silent enemy of every investor, and in Brazil, it's part of our economic DNA. In today's video, I'll show you how foreign investors can protect their capital from Brazilian inflation, understand the real risks, and even turn them into opportunities. Inflation is one of the biggest risks for any investor because it quietly erodes the value of your money over time. Even if your nominal returns look good, what really matters is your real return after inflation. Right now, Brazil's key interest rate, known as the Selic, is around 15% per year. And that's the nominal rate. But once you subtract inflation, your real return is much lower. And that's what truly defines your purchasing power. For example, if inflation runs at about 5%, your 15% nominal yield actually gives you roughly 10% real return, which is still among the highest real interest rates in the world. Let's make it practical. Suppose you invest $1 million in a Brazilian fixed income asset yielding 15% per year. That means about $150,000 a year, or roughly $12,500 per month in income. But if prices increase 5% annually, that same $12,500 won't buy as much next year. You might need $13,000 or more to maintain your standard of living. So one of the simplest ways to protect your capital from inflation is to withdraw less than you earn, allowing your investment to keep growing. That way, your returns can adjust over time and preserve your real purchasing power, not just the nominal amount. In short, in Brazil, high interest rates may look attractive, but only your real return tells the truth about how much your money is actually growing. Now, if you don't live in Brazil, you're not directly affected by Brazilian inflation in your daily life. Your rent, groceries, your healthcare costs are based on your home country's economy, not Brazil's. But if part of your investment portfolio is allocated in Brazil, that portion is absolutely exposed to local inflation. When prices rise here, the real value of Brazilian assets can decline, even if on paper the nominal returns look high. That's why diversifying into Brazil should always be seen as both a return opportunity and risk decision. You're adding exposure to one of the world's most dynamic emerging markets, but also to local inflation, interest rate cycles, and currency fluctuations. For many foreign investors, this combination can make Brazil an attractive high-yield destination, but it also demands a deeper understanding of how inflation and exchange rates interact. In other words, when you invest in Brazil, you're not just investing in an asset, you're investing in a different economic reality. Now let's look at Brazil's latest inflation data, all based on official information from the Central Bank of Brazil. Every Monday, the central bank releases what's called the Focus Report, and it compiles market expectation from more than 100 banks, investment firms, and consultancies across the country. The bank publishes the median forecast for key indicators, including inflation, IPCA, GDP growth, and the Selic interest rate, and the exchange rate as well. And this report is one of the most trusted economic references in Latin America, and it gives investors a clear sense of how the market expects Brazil's economy to perform over the next few years. According to the most recent Focus Report, inflation in Brazil, measured by the IPCA index, is expected to reach around 4.83% in 2025 and about 4.29% in 2026. That's above the official inflation target of 3% per year, but still within the tolerance range set by the central bank, which goes from 1.5% to 4.5%. To keep inflation under control, the central bank uses its main monetary policy tool, the Selic rate, currently at 15% per year. And this is one of the highest interest rates in the world, designed to reduce credit and consumption and to keep inflation expectations anchored near to the official target. But these projections are just that, projections. Like any emerging market, Brazil is exposed to what economists call inflation surprises. Sudden changes caused by commodity prices, exchange rate movements, or fiscal pressure. So even though forecasts point to inflation gradually converging to the target, investors should always consider the possibility that inflation could stay higher than expected. In the next video, I'll show you how foreign investors can structure their portfolios in Brazil to protect against inflation and maintain real returns even when prices start to rise. So, are you ready to invest, relocate, or access risks in Brazil? At p41.com, we are a multidisciplinary family office dedicated to helping foreign investors make informed, confident decisions. Our team of attorneys, tax specialists, financial advisors, and investor relations experts work together to design the perfect portfolio tailored to your goals, protecting your wealth while aligning with your life plans. If you're looking for real, reliable, and actionable information about investing or living in Brazil, we're here to help. Contact us via WhatsApp at +1 646 418 2541 or visit p41.com to schedule your consultation today.